Hello, everybody. My name is James Blair. I'm a financial advisor. I'm joined by Movember Michael Vincent, also a mortgage advisor. Will help you with all your lending questions. We've been doing these webinars with Engineering New Zealand now for 2-3 years. And I mean, this year's been a tough year. Like if you think about, Mike, the statement, interest rates have tripled. It's a bonkers statement.
Yeah, it is absolutely crazy. And it's funny, I don't think, even though rates were artificially low, I don't think anyone really thought about the pain of what happens when interest rates triple when they were fixing at 1.99 for 1 year. You know what I mean? A lot of people are rolling off those rates onto 5-6%. That hurts.
And for those that locked in for 5 years at 2.99, do not go telling people you are the most hated people in the country right now. So this webinar is really all about it's been a tough year. Cost of living through the roof. Interest rates are continuing to go up to try and mitigate that. Kiwi saver balances are down. The share market's down. The property market's down. One of my favorite statements at the moment is everything I buy is up and everything I own is down. So we're going to talk about all of those things today. There's a QR code there, which has a link to our weekly podcast, which talks about these sort of things all the time. But you've given us an hour of your time. What we're going to do is talk for probably half an hour, and then we want to do as much Q&A, put the questions in the Q&A as we go. And we really want to make sure you get out of this session what you want and ask those questions. So we've got a poll question, which of course I knew was coming. Are you worried about the New Zealand economy? Not really, a little, definitely. It keeps me up at night. Hopefully it's not keeping you up at night. I will say, am I worried? I'm more a little worried.
Yeah, it's an interesting one. We do hear a range of answers on this from different people. A lot of it really depends what sector of a lot of the time what sector they work in as to how worried they are. Am I worried about the New Zealand economy? A little bit, but everyone needs a recession every now and then to clear out the dead wood.
Yep. Yeah, and that's right. The other thing to remember is Mike talked about those artificially low interest rates. We haven't had a really big drop in the share market since 2008. We're definitely due for these things. Mike, talk us through those poll results.
Yeah, cool. So 14% not really, 50% a little, 33% definitely, and 3% of you are being kept awake at night by the state of the New Zealand economy and what might be just around the corner.
Cool. Okay, well, let's tackle all those questions. So for those who don't know who Mike and I are in Lighthouse, and so we are based in Auckland, got customers all over the country. Our mission as a business, our purpose is to help secure Kiwis' financial future. We believe that fundamentally means education plus action equals freedom. So education is part of today's session, but Mike, listening to one webinar does not equal freedom, does it?
Yeah, if only this was all you had to do. This is just the education piece. What we are really trying to be a catalyst for here is to get you to take action, whether that is taking action with us, taking some sort of action on your own. That if you don't take the action step, you're never going to get to the financial freedom piece.
Yeah. And then, so on that, we do a lot of these webinars, but we have accountants, mortgage brokers, financial advisors, and insurance advisors. We do offer one-on-one sessions at the end of this. It's not some sort of heavy sales pitch or anything like that. We know people come and talk to us when they need help, or if you've got somebody you're working with already, that's cool. But our purpose is very genuine, where people say money doesn't buy happiness, but it's bloody hard to be happy if your finances are in shambles. Yep. So money's about two things. One, it's about security. Second, it's allowing you to enable you to live the life you want to live. So that's what we're about. We do a lot of these webinars, a lot of these sessions. I think we're going to do a roadie next year and do some seminars in person with Engineering New Zealand, which should be a little bit of fun. Mike, you, me, and Ravi on tour. How good?
Yeah, that'll be really good.
Yeah, so we've taken about 5,000 people through our webinars and seminars, really good feedback, worked with a lot of really big businesses. So essentially that's saying, hey, you should listen to what we have to say. We can help you.
Cool. So because both James and I are financial advisors, we are going to need to put a disclaimer on this webinar. So look, the information that we're giving out in this webinar is not personalized advice. We're just talking in general terms to give you information, to get you thinking, to get starting to try and be that catalyst to take action. If you do want to discuss your personal situation with us, book in a time, sit down. We can give you far more personalized advice, be much better. You know, we love the Q&A session. Like it is our favorite bit by far. We do not like sitting on the fence. We will try and answer all of your questions. But if you start saying, oh, look, I'm 27, my partner's 30, I earn X, they earn Y, how can I borrow? What should I invest? That's personalized advice. We can't do that on this webinar. We need more information.
Come on, Mike, don't be a party pooper.
Buy a haunted house in Freeman's Bay. Cool. So in this webinar, we're going to talk about a quick market update. So what's happening out there, what you'll see in the media, what the reality is. We're going to run through a couple of really key sort of points you need to know. Inflation, you'll hear about it a lot at the moment. You need to know what inflation is and how it sort of impacts you. How inflation and interest rates are tied together, because again, the interest rates on your mortgage are most likely going to impact you as well. A quick, what has history shown us? I'm not going to spend too much time on that, but I just like to illustrate that actually we've been here before. And then we're going to give you some information about what you should do. So, you know, should you pay down debt? Should you invest? What should you be doing when the market is like this? And then, like we said, Q&A, questions and answers, our favorite bit.
What to do does sound very definitive, doesn't it?
It does. Full stop after
it. The other thing with this whole session is everybody's got a different level of financial literacy. So that's why the questions are really important, because we will pitch this at a certain level to try and kind of give as much information at the right level as possible. But you got to ask those specific questions. Market update 2022. I won't use poor language. It's definitely been a show and not a great one. So if we break it down, the share market has had the worst first 6 months to the year since the 1970s, and it hasn't got any better in the last 6 months. The property market, which never goes down, has gone down. Interest rates have tripled. Inflation's pretty much around 10%, and people were hoping it would drop, and it hasn't done so now. We've got wars overseas. We've got COVID, supply chain issue hangovers. She's not a lot of fun. And unfortunately, the media's job is not to say, hey, chin up, buddy, it's all going to be okay. They sell papers pretty much based off misery. So their job is to go, yeah, no, the housing market's like in shambles. There's bubbles. KiwiSaver balances are dropping. And Mike, sometimes that can make people pretty worried and sometimes make quite poor decisions, right?
Yeah, absolutely. And I think, you know, again, their role is to sell papers and provide information. However, it does spook people into making really poor decisions. What's the stat? I think it was how many billions went from aggressive into conservative KiwiSavers at COVID?
I think it was like $1.4 billion went from aggressive to conservative cash KiwiSavers, actually.
Yeah, and when you've, you know, just for a quick sort of example, if the loss has already happened, shifting from an aggressive fund into a cash fund is just going to crystallize that loss. So, you know, potentially we would be giving different advice there to people. So making decisions purely based on what the media is saying can sometimes really lead you down the wrong path.
Yeah, and everyone will have like a crazy uncle that'll have their opinions on what's happening in the world at the moment. But one thing I can tell you for sure is if you can have a plan and make long-term decisions, not short-term emotional ones, there is money to be made in times like now. Probably more money to be made in times like now when the world's pumping really good and everybody wants a slice of the action.
Yeah, it's really, it's a funny one, right? Because we don't want to be too aggressive with advice. And obviously everyone has a different risk sort of profile. But like we sort of said, as we were talking about before the webinar, you know, I'm going out putting offers on houses might seem quite crazy, quite risky, because actually when the market's down, there are real bargains to be had in the property market.
Yeah. And everyone thinks the market's never going to recover and inflation's going to go on forever. But the reality is, as this might not sound the best, but there's always a war. There's always a financial crisis. There's always a pandemic. There's always something, there's conflict in the world. There's something happening, which means that every 7 years or so, there's going to be a year where the world absolutely craps itself. And then there will be a recovery off the back of it, even though the world didn't think so.
Yeah.
If we jump onto the slide, we've got, this is fascinating at the moment, Mike. The fear versus greed index. Mike, do you want to tell us what the fear versus greed index, like, what is it?
Yeah, so the Fear and Greed Index is a survey that goes out globally, and it measures how what people's sentiment is in the economy. You can see here it runs from extreme fear to extreme greed. I would argue in New Zealand that actually this is probably a little bit out of kilter. We are probably not at greed at the moment. We're probably a little bit more in the fair and neutral camp, but like I said, it is sort of a global survey.
Yeah, it really surprises me. The people I talk to is definitely somewhere between fear and extreme fear, I'd say. And if we made the assumption that that's where we are at the moment, Warren Buffett's got a great saying that I do love, is be fearful when others are greedy and be greedy when others are fearful. And at just times like now, it's just important to make rational, sensible decisions about your situation.
Yeah.
I've already kind of talked about this already. So the share market, so since the global financial crisis in 2008, the share market has done somewhere around sort of 10% a year up to 2020. We were well overdue for a market downturn and some negative returns. And we finally seen that happen in 2022, which is no surprise, which has really got to do with all central banks around the world pumping a bunch of money into the economy, money getting really, really cheap, but there's no free lunches. It's resulted in a hangover off the back of it. And we've seen the share market back about 20% this year. Yeah.
It's an interesting one. On the podcast, we did a review of financial advice that people were giving on TikTok. And it is so good to be able to look back 12 months and just see that every one of their stock picks is just, completely wrong.
All right, Mike, talk to us about inflation.
Yeah, cool. All right, try and stay awake for this one. Look, inflation, it is everywhere in the economy at the moment. It is all over the news. It is really important to understand what it is and how it's going to affect you. So, the easy explanation, it is the average rise of goods and services in an economy over time. It's measured through the CPI, or the Consumer Price Index, which is actually just a basket of goods that your general consumer uses over 12 months. There are some key things that are left out of this, though. So sometimes you get a little bit of a skewed result in terms of your inflation number, and a lot of the time it can be running a lot higher than it's actually reported. Now, how is this going to affect you? Day to day, you can already see it in the economy. Cucumbers are like $10. I don't know how much cauliflower is. Gas is through the roof. House prices were through the roof. It is everything around you getting more expensive relative to your income. So aside from general things being more expensive, how is this going to impact you? Ravi, next slide. Cool. Here's a little bit on inflation history quickly. You can see here that inflation has been running, 20% in some instances, but this was a long time ago. In '89, the Reserve Bank of New Zealand was enacted with the task of keeping their inflation rate between 0 and 2%. This target has changed slightly, where they now look at employment as well, and keeping one of their targets is to keep a full level of employment in the market. But generally speaking, their primary goal is to keep inflation between 0 and 2%. That was updated to 3%. So they've got a little bit of sort of room to run there. Why do they want some inflation in the economy? Well, having a low natural level of inflation in the economy is actually good for an economy as a whole. It encourages people to spend and not just save all of their money and not keep the economy ticking over. We were struggling for a long time in New Zealand and globally to get inflation to a reasonable level, sort of I guess, to prop inflation up a little bit to keep the economy ticking over. However, over the last 6 months, 12 months, inflation has been running at very high percentages. We're looking at inflation of around 6%, 7% in some instances, which is way above what the Reserve Bank should be tolerating.
Mike, if I can just add a little bit of analysis to the slide, I think the last time inflation was as high as it is now was when the mustache was last popular.
Yeah, no, absolutely. But again, aside from just everything being more expensive and it kind of hurting a bit more when you go to the grocery store, why is this important? Well, the Reserve Bank's primary tool to control inflation in the economy is the official cash rate. And the official cash rate is going to dictate pretty much how much your mortgage costs. So the retail interest rates. And I know some of you will be on the call saying, actually, it doesn't directly dictate that. It's through a whole lot of other mechanisms, and banks borrow in the interbank money market. Yep, I get all that. But for your general punter, if the official cash rate goes up, the interest on your mortgage is going to go up as well. So when the interest rate on your mortgage increases, you have to shift more of your free cash or your pay packet towards the mortgage. Means you can buy less in the economy. That will dampen demand, and that will bring back that inflation number. So again, interest rates, we said they have tripled over the last 12 months, and they have. A normal interest rate in New Zealand is not 1.9%. It is not 2%. It is about that sort of 4, 5, 6%. That's probably that is where monetary policy is most effective in New Zealand. So, yep, we had some absolute sugar high interest rates, some specials that were, way down at that 1.992%. It is unlikely that we will see those for a long time until the economy is really going backwards and needs some juice pumped into it.
This actually scares me quite a bit, because the conversation I'm having with some people where they've planned either their personal mortgage or their investment property on 3% interest rates and are really struggling now. And I also worry about all the people who haven't planned for it yet, or their rates haven't rolled off yet, and the pain they're gonna feel. So, Mike, what tips would you have for those who haven't felt the pain yet of interest rates rolling off? What would you say they should do?
Yeah, hold on to that rate as long as you can. Look, we sort of reasonably expect interest rates to continue to increase over the next 6 months at least. We've got another rate decision on Wednesday next week, I believe it is, and then we have another one in February. You are likely to see a 0.5 increase next week and a 0.5 increase again in February. Reason for that being is that if you're trying to control inflation, and one of the main drivers of inflation, apart from the supply side, is the demand side, the demand over Christmas for goods and services and people spending money is going to increase dramatically. So it's unlikely that we're going to see your inflation numbers decrease over summer and Christmas. So you'd like to see 0.5 and 0.5 again. You need to be expecting that you are going to roll off your rates onto higher interest rates if you're rolling off in the next 12, 24 months. You should be looking at your budget, at your finances now, and thinking, okay, what can can I afford this? Is there anything I can adjust? Do I need to start saving now? Because in the future, it's going to be a little bit more painful in terms of the amount of money I have, because it is not going to get better anytime soon.
Yeah.
Sorry to be sobering.
Yeah. So far we've spoken a lot about, like when it comes to the share market with KiwiSaver, because I mean, the other thing with everybody here, right? You're continuing just to pull money into KiwiSaver with the contributions. Balance hasn't gone anywhere for a year. What's going on? There's the share market being down, inflation being high, interest rates being high. The big question is, what should you do? The word portfolio is in here, but it's really, what should you do with your situation? The first thing which removes emotional decision-making is to have a financial plan. So a financial plan can come in lots of different forms. That's what we do in the Wealth Team every day. We help build financial plans for people, help them work out their goals, where they want to go, what the right approach is. But even if you don't have something like that, like where are you going? What are you trying to achieve? We really hate selling assets. So whether it's selling down shares, moving to lower risk Kiwi savers, selling houses, really trying to avoid those things if we can. But understanding where you are now, where you want to go, if things are dropping in value, does that impact your ability to achieve your goals? Because newsflash, all of these problems are going to happen again in 5 or 10 years' time. Yeah. What are you going to do when it happens again? It's about being consistent with a plan, whether the markets are up or down, that you stick with the plan. If you're in a position to buy and kind of take action right now, you know, there's discounts out there, but being quite clear and with your decision making, because the reality is the current situation will not last forever. Inflation will drop at some point. House prices will increase in the future. Shares will increase in the future. It's just when. And I like to say that if you want to know what will happen in the next 12 months, like whether something will be up or down, that is called gambling. We do not gamble. But if you want to make a plan over 10 years, property market will increase 5 or 6% per annum over the long term. Share market will increase 8% per annum over the long term. We know those long-term outcomes. So a plan is really important. Second thing, reviewing your risk. Back into last year, everybody was being super aggressive with their Sharesies portfolios, with their Kiwi savers. Mike, everybody was borrowing as much money as they could to buy as much property as they could. And then it dropped. And some people were like, oh, I didn't know it could drop. Or I didn't know it would feel like this when it dropped. This is a really good time to review your risk level. And then if you want to do something with, like if you've got shares or crypto or anything like that, and you have short-term goals, they should have never been in those assets in the first place because you don't have the time frame to get the outcome, those averages we spoke about. So you should be thinking about whether they're the right levels of the right kind of investments for you at all. Mike, I mean, on the home buying side, people being invested in risky assets with short time frames, it doesn't work out well, does it?
Yeah, especially not if you need your deposit in the next 12 months. We've seen some terrible advice where people have been advised to put their deposit funds in the stock market. And then, you know, all of a sudden we got to settle a property and we don't have enough money. It's really important, again, on the risk side of things, to actually think about what is the risk of the asset, not what do you perceive the risk to be. When the market's on a bull run and every share is increasing, it's very easy for you to look at it and go, well, shares aren't that risky because it's been going up for the last 5 years. It'll keep going up. You need to think about the underlying risk of the asset and should you be investing in it? And I would bet for the majority of the people on the call that if you are directly investing in shares via Sharesies, you don't actually know what the underlying risk of that asset is. You haven't done a full analysis of the company. It's not your day-to-day job. And actually, it's a little bit more gambling than people think.
Yeah, that Netflix doco on GameStop is phenomenal and just takes home that point. Ravi, where are we going? I'm not done yet. Go back. Couple other points. So actually, I could see how you got confused with me. Diversification. So diversifying off investment properties or diversifying across cryptos is not diversification. And diversification depends on your situation. Sometimes it's okay not to be diversified. For example, with the Sharesies accounts, if you've got a mortgage, you probably shouldn't have a Sharesies account. Reason for that is if mortgage rates are at 6.5%, you're making 8% on your Sharesies portfolio, but then you take off fees, tax, and inflation because you're not spending the money now, your net real return is probably 3%. So diversifying in the right at the right times. Already banged on about being long-term focused, not short-term focused. Make an active choice of KiwiSaver providers and funds while you're at it. And the other piece is like a good financial plan should have what are your goals? How are you trying to get ahead? What is important to you to achieve? How are you going to grow your wealth? But also protecting your wealth. So get a will, look at the structure of your assets. Most people, their biggest assets, their health and their income and their ability to earn. You should get income protection insurance. And if someone's dependent on you, have a chat about life insurance, and we can help with all of these things. So if you need help with one of these things, just let us know.
Yeah.
But talking about diversification. So this table right here is showing from 2007 to 2018, the top performing asset in some years. So gold, geez, did gold have some great moments? Unfortunately, over the last decade, gold prices have literally gone like that, like a smiley face. They haven't actually gone anywhere. But this graph here just shows that with each asset, there's really good years and really poor years. And it's very hard to work out which ones are which. In 2021, the New Zealand Stock Exchange didn't grow at all, but the S&P 500 grew 20%. It's kind of like, how are you going to pick that? So being well diversified is really important, which is what this slide's all about.
Here's high yield bonds in 2009, 62%. It doesn't even make the chart for any of the other years.
Yeah. So for those who have some cash that they might want to invest or working out, some people go, Mike, tell me if you've heard this one before. I'm just going to wait a couple of months for the market to go down, and then I'm going to invest.
Yeah, we hear it in the property sector all the time. And specifically to the property sector, the thing that people don't think about is house prices are going down in part because interest rates are increasing. If you wait 6 months to get a pre-approval, as interest rates increase, the amount you can borrow decreases. So actually you're in the same position, if not worse.
One of my favorite ones at the moment, which was a Tony Alexander comment, was in 1982, do you think your Auntie Gertrude was like, yeah, house prices are at 65,000, but if I wait 6 months, I think I can buy my house at 63,000.
Yeah, it's quite good.
In another 20 years, it will be the exact same conversation because of inflation and the world growing.
Yeah.
So we've got a study along these lines, which was done by Charles Schwab, which I'm sure is everybody's favorite bloke to do studies, which was from 2000 to 2020. If you had $2,000 to invest each year into the S&P 500, which is the top 500 companies in the US, and you had 5 different investment approaches, what would be the difference? Does trying to time the market actually matter? So we've got 5 different investing styles. Mike, maybe we'll go one for one to mix it up a bit.
All right, I'm going to start on Peter Perfect because, that's me. Look, so Peter Perfect, he picked the single best day in the year to invest. Impossible.
Yeah, so it was the lowest point each year across 20 years. That man's great. Ashley Action does not muck around. She invested her $2,000 on the first day of each year, could not wait to get involved.
Yep. We've got Matthew Monthly. So divided his annual $2,000 into 12 equal portions, invested on the first day of every month. This is what we call dollar cost averaging.
Rosie Rotten is the complete opposite to Peter Perfect. She picked the worst day each year to invest, unfortunately.
Yeah, almost as impossible to do as Peter Perfect, or just as impossible.
Yeah.
Larry Linger, so left all of his money in cash, didn't actually invest in the stock market at all.
So let's have a look at the results. So over 20 years, if you pick the perfect day each year across 20 years, you'd have 151,000. If you just took action on the first day of the year, you'd end up at 135. Dollar cost averaging was pretty much the same. Horrible timing. The worst day every year across 20 years, still $121,000. And if you stayed in cash, didn't do anything, you'd be at $44,000. Mike, what do you think of the lessons here?
Yeah. So don't get me wrong, looking at Peter Perfect and all that sort of thing is great. Earlier in the presentation, I said, everyone just wants to listen to the actual seminar and think that that's all the action they have to take. That is not taking action. You can see here the difference between having the worst timing and doing nothing. It is a huge difference. The earlier you take action, the better, and the less sort of sacrifices you have to make.
Yeah, and if we think about like Larry Linger, that's who we want to help the most. Larry Linger, and we've got a lot of engineering clients, and paralysis by analysis is definitely, sometimes people can be too smart for their own good. And there's a lot of really smart people who are Larry Lingers just because they want to understand the pros and cons and weigh them up, and maybe I can find something better. So Number one lesson is getting your money to work. Even if you pick the worst time, and you're still 3 times better off than leaving your money in cash, because the worst day today is still an amazing day 10, 20 years from now.
Yeah.
And though, like dollar cost averaging, for example, the markets go up more than they go down. So usually people are, you're better off just getting your money to work and getting on with the show.
Yeah, if there's one thing that you're taking from this presentation, I'm sure James might have a different thing. For me, it is just take some action. Whether it is having the discussion with someone about your KiwiSaver, looking at maybe investing in a index fund if that's right for you, just doing something to put something in action, which means you'll be better off in the future.
Yeah, and on the flip side, if you're already invested, as long as you can manage the cash flows, just hold on, because the pain of this year will not last forever. And if you sell that house and you look up the value in 10 years' time, I promise you, you're going to be very, very sad.
Yep.
And this just emphasized the point. So the S&P 500 over the past 50 years, 40 out of those 50 years, it's gone up. The average return is around 11%. Of those 50 years, 18 years have seen a 20% gain or more. And just to show how unique this year is, 3 of those years have seen a 20% loss or more. So those big losses do happen. They are painful if you have short-term goals, but if you have a long-term goal and I've got a good financial plan, it's just a number on paper. I know that sounds somewhat insensitive, but these times are going to happen. You look at the graph, look at it goes up, look at it goes down, and look what happened over time. And if we also look at that graph and look from 2008, which was the last really big drop, to now, I mean, we were due. We were 100% due for a 20% drop back.
Yep.
So, like I said right at the start, this is not like some sort of sales pitch to go, hey, come and talk to us and let us sell you a product or anything like that. We do all of those things. But if you want to have a chat about your own situation, if you feel like you can be doing better, if you feel like you need to have a plan, if you feel like you're worried about your situation, I mean, that's what we're here to do. That's what our relationship with Engineering New Zealand is all about, is to help empower you to make better decisions. So Mike will talk about what you can do on the mortgage side in a second. If you want to talk mortgages, hold up on that scanning. There will be another one that'll pop up. But if you want to talk about a financial plan, financial plans are underdone in this country for some reason. I think it's the DIY mentality. But if you want to talk about how you can make the most of your situation, peace of mind, clarity, scan the QR code, talk about risk, talk about diversification, KiwiSaver. Insurance doesn't have too much to do with this webinar, but just on a side note, if you haven't got life insurance or income protection or health insurance, or you haven't reviewed it for a period of time, again, I've been meaning to get around to it, we can also talk to you about those things as well.
Yeah. Cool. So what to do with your property? Now, there is, again, a lot of mixed messages out there in the market at the moment. Some sort of fundamentals that I can mention on the webinar. If you do have a property and you have, continue to pay down debt on your owner-occupied property, if you have investment properties and an owner-occupied property, be focusing on that owner-occupied property first. You might get different tax treatments on the debt, perhaps, but you should be focusing on reducing that debt as much as possible, especially as interest rates climb. Less debt, less interest cost, you'll be better over time. Review your property portfolio. So if you have a couple of investment properties and an owner-occupier or just investment properties, now might be the time to start thinking about, hey, do I get an accountant to look at this to try and tell me what the tax implications are going to be in a couple of years when my interest deductibility rolls off? Is it worth me trying to sell a property now? Do I hold on? Is one of my properties better than the other ones at the moment? What does all of that look like? Review your property portfolio just so you're not caught out with a huge tax bill when that interest deductibility rolls off. You've got an existing mortgage, review that loan structure. Are you fixed? Are you floating? What terms are you fixed for? Is it worth breaking and fixing? Should you be fixing for longer terms? How long do I expect interest rates to keep climbing for? And then when are they going to start falling? Do I fix for 2 years, 3 year, 1 year? Now is the time to have a look at that loan structure to make sure you're not paying unnecessary interest and you're not exposed to those sort of, rate hikes that we're going to see over the next 6 months. If you're buying soon, make sure you're locking in how much you can borrow, because as I said before, as interest rates increase, the amount you can borrow decreases. So it might be better get a pre-approval at now, but if you've got a deposit that you've been saving, make sure it's not at risk. It shouldn't be in crypto. It shouldn't be in the share market. It should be in cash so that you know exactly how much you've got when you need to settle that property. Cool. So here's a quick question that we get asked quite a bit. Should I pay down my debt or should I invest? Look, at the moment, I don't even really need to run through the slide. You should be focusing on paying down your debt over investing in the stock market, given the returns. James, anything you want to chip in on that one?
I think like the math I've already run through of why you should do it. There's also the psychology behind it as well, that it's sexier to be investing or doing something and to be telling your mates about the punt that you took and that your shares are up through the roof, and you say your wins, you don't tell people about your losses. The math is the math at the moment. You should be keeping it simple, focus on repaying debt, making sure that you're paying less interest costs essentially.
Yeah, and it may seem like we've just sat on the presentation and been like, don't do this, don't do this, don't do this, don't do this. Unfortunately, at the moment, you do have to focus on the simple things, the things that aren't so sexy, like paying down the mortgage, making sure your equity is right, making sure your loan structure is correct, making sure that you've got the insurance and that sort of safety net around your financial plan. It'd be great if we could sit on here and be like, absolutely, go remortgage the house and put it on some stock, but we're just never going to do that, especially not in this market. Cool. So if you want to have a chat to the mortgage team, scan the barcode there. You'll be able to book in with one of us. We can talk to you about, how much you can borrow if you are looking at borrowing, where might be best for you to borrow, any tips and tricks to sort of increase that pre-approval amount a little bit. We can get that pre-approval for you. So I guess the advantage of us is you do one application, we can go out to a number of different banks, pick the one that has the best credit policy or the two that have the best credit policy for you, and then negotiate off sort of the rates at the other end as well. We can give you advice on property. So whether that's an investment property or your owner occupied property, talk to you about the style of property that you're buying, the advantages, disadvantages, discounted interest rates for new builds, all of that sort of thing. If you want to talk about your existing property and the structure of the mortgages, we can do that as well. We're getting a lot of people coming to us for that at the moment because they are very worried about what happens when they roll off 3% on a 6%. Next, properties and investment properties as well. Happy to run through that with you. We can point you in the right direction in terms of, again, the style of property you're buying, what would work best for your portfolio, and if there are any bargains sort of in the space that you're looking for. So yeah, scan there, have a chat to us, and we can point you in the right direction.
Cool. And if you go, these two guys, they have phenomenal chemistry. It's because we do a lot of these webinars, seminars, and we also do a weekly podcast called Checks and Balances. So you can check that out on Spotify, YouTube, Apple. Ravi might pop a link in the chat. But it's really all just about that education plus action equals freedom. More education. This week we've done a review of the Barefoot Investor book. We've done like a what do you do once you've paid off your mortgage episode recently. What else have we done, Mike?
We've done a lot on property as well. So different styles of investment properties, these sorts of things, as well as our weekly podcast. We also have sort of shorts episodes called Money Bites. So if you're listening to us and we're using jargon that you don't understand, LVR, CPI, all of these sorts of things, we've got a whole series which just explains financial jargon as well.
Cool. Okay. Now, I don't want to judge this group, but we haven't had any questions. We've got a couple questions, but I really think we should have quite a bit more. Robert White, shout out to you. The two questions are from you. So love your work. We will jump into them now. You've given us your time today, and it's really important that you ask us now the questions so we can help you out. While we do that, we ask for one thing in return, non-negotiable, as part of us giving you our time and sharing our knowledge, is you fill out the survey. So Ravi will put a link to the survey below. Let us know how you found it. Up above, Kirsty and the Engineering New Zealand team are keen to hear about other webinars you're keen to have and other events. So please let us know. Chuck in those questions and we'll jump straight into it. Mike, what's the first question?
All right, first one, managed or tracker fund. That is definitely for you.
Yep. The main thing with managed funds is you just want to be careful of the fees and the fees after. So like the returns after fees. So statistically, it's quite hard to outperform the market long-term as a active fund manager. So that's where you've got some stuffy old bloke behind a desk picking stocks who's paying you're paying lots of fees to. You can get some more diversification. There's a couple of interesting things around managed funds. Index funds are great solutions. Platforms like Kernel Wealth, really good one to have a look at. I'm not too bothered either way, as long as you're just conscious of the returns after fees.
Yeah. Cool. Next one from Robert. Are you commission or fee based, or do you offer both options? I'll start with you.
Cool. So for financial plan, we charge like a flat fee. If you want us to give advice on KiwiSaver or insurance or investment property or those sort of things, there might be like a product list where they pay us, but we will always disclose those things to you. For a financial plan, we charge $2,000 plus gist. So pretty much the same cost as an iPhone for you to have clarity and peace of mind about your future. Mike, you?
Cool. So we work on a commission basis pretty much. So we will, for retail anyway, we get paid a percentage of the loan that draws down from the bank. Different banks pay us different amounts. So ANZ might pay me 0.85%, Westpac 0.6 plus some trail. So it really varies on the bank. We disclose upfront what we get paid. And I will also disclose if I recommend one bank over another, what both banks are going to pay me as well. We do charge some fees. I will charge fees if you are purchasing a commercial property, usually 1%, or if you're doing an institutional level product, like development finance or something like that, we'll charge 1% for that as well.
Yeah, and I don't mean to bang on about the fees bit, but our approach is definitely look after the customer, do whatever the right thing for customers. We'll get looked after like long-term as part of that. And just to prove the point, check, like if you Google Lighthouse Financial, you'll see like 80 odd 5-star Google reviews. I'm just going to jump order, Mike, just because we're quickly talking about fees. Bridget's asked, is there a fee for the half-hour wealth or mortgage session? No, we'll give you half an hour of our time at no cost. The reason we don't charge a fee is because we need to work out whether we can help you or not first. Or like as part of this thing, we also just like completely appreciate that some people just want to ask us a question or two, and maybe you'll come back to us in a year, 2 years, 5 years when you need help with something else. So there's no cost for the 30-minute chats. Great question.
Yep. Cool. Mark, working for the private sector, when performance review comes around, should we be checking the interest rate to ensure our employers are giving us a fair increase? I don't know about the interest rate or the inflation rate. I'd just be asking for as much as possible, to be honest.
Take them to the cleaners, Mark.
Pretty much. I guess it's that might be something you want to bring up to sort of say, hey, look, we're not even keeping up with inflation. But to be honest, I would base it on something else over and above that.
The thing I would touch on with the performance reviews piece is two parts. One is from a business's perspective, you don't ask for just inflation when it's 0%, 1% or 2%. You want more than that at those times. So inflation is an important metric, but you're not always going to be focused on that metric as inflation is low. The second thing, depending on the business, I mean, a lot of engineering business have done phenomenally well over the past couple of years with money being pumped into the economy. But the other part to take into consideration is for businesses, the cost of everything is more expensive. So it does depend on, just because of the inflation rate, what the business might be able to do might be completely different. But yeah, definitely that time of the year, come armed, ready to roll, because I like to say I don't have an expense problem, I have an income problem. So let's get those salaries up.
Yeah, I love those negotiations. They're so much fun. Cool. Anonymous attendee, thoughts on buying property or investments overseas? Ooh, I mean, investments overseas is probably a little bit more on James's side. Look, to be honest, I don't really know a lot about the property market in other countries, apart from countries that I've lived in, like Australia and the UK. But I can't give advice on that. I'm only really going to give advice on properties in New Zealand. Yeah.
My whole point would be why. So
Yeah.
like, I mean, maybe you're from that country, maybe there's something, but we like to keep things simple. Like, what are the tax implications? All of those kind of things. Yeah, usually it's no, but there can be exceptions.
I mean, 2 words really, if you're looking at buying in Australia or the UK: stamp duty.
Do you just want to quickly explain what stamp duty is, Mike?
Stamp duty is a tax you get on a transaction for a property. You do not get it back. If you buy the house, you pay stamp duty. If you sell the house, you do not get that tax back. I can't remember the exact rates, but I remember when I was looking at a property in the UK, it was like 25,000 or 30,000 pounds or something like that. And I was like, well, no, maybe not.
Yeah. Cool.
So yeah, think about the transaction costs and the exchange rate risk as well.
Yeah, exchange rate risk. The US dollar at the moment, crazy.
Yeah. Okay, Craig, do you rate the book The Psychology of Money, or any books you recommend? James?
I haven't read The Psychology of Money. Anything to do with psychology of money, though, like I can guess the kind of concepts going around it. That's because people look at things like just based off the math and what's the right, and we're humans. It's not really how we go about things. I do like The Barefoot Investor, the book we've just reviewed. I don't like everything from it, but I do like The Barefoot Investor as a book. Rich Dad, Poor Dad can be good to explain some important concepts of money, but just remember, you don't have to take everything from a particular book.
Yeah. Any books I recommend, to be honest, as I love reading, I don't read a lot of finance books. I listen to finance podcasts instead. I find it much easier to concentrate.
Now what podcast could you recommend, Mike?
Yeah. No, there's a number of good ones out there, obviously our ones. And you can get really specific with the podcast as well. There's some right on property, there's some right on sort of New Zealand economic data, especially also again in the property market, and more general ones as well. So yeah.
Now, Mike, let me ask you the next question. Do you recommend as a first home buyer to save for another 6 months or buy now?
I mean, I don't really know how to say this. Buy now. These are long-term assets that you're going to hold for 5+ years probably. The market is down. Everything is on sale. When Briscoe's goes on sale, you don't usually go, oh, I'll just hold off and see if the next sale is better. You jump in. The other thing, just around the time frame here, so 6 months. If you came to me and said, hey, Mike, can you get me a pre-approval? What you're doing is locking in exactly how much you can borrow with the bank, and that can last for up to 6 months. So usually lasts for 3 months, and then we can roll it again for another 3 months. As interest rates increase, which they are going to continue to do, the amount you can borrow decreases. If you wait for 6 months and all else remains the same, it is likely you'll be able to borrow significantly less than 6 months than now. My advice would be, even if you do not buy now, to get the pre-approval now and hang on to it over that time, so you can jump in on a bargain when it arises, or when you find a property that you really like.
And coming back to that point before around, like, house prices are down 10 to 20% right now. They could drop another 5 or 10%, but you do not know whether that will happen. You have a guaranteed discount right now. And coming back to our Auntie Gertrude before, if you are, like Mike said, if you are buying this for the long term, like an extra $50,000 difference, I know that just sounds crazy. It's immaterial over a really long period of time. Take the discount you can get. Otherwise, what usually happens is people, they keep waiting, the market turns, and they've missed out completely.
Yeah, it never is the bottom of the market. It was the bottom of the market. So you're going to be looking back retrospectively going, I should have bought then. The other thing is, getting a pre-approval isn't going to cost you anything. It might cost you some time, but you can go out, get the pre-approval, sit on it and do nothing for 6 months. And then in 6 months' time, if you see something and the market's dropped a little bit, jump in them.
That's a big thing about the mortgage side is, like, what can I borrow? What can I do? You just won't know unless you have the conversation.
Yep. Cool. From Colt, I am wanting to book an in-person meeting on behalf of a family member. Is there someone I can email to organize this? Yeah, our links should be in the chat function, and there'll be an email after this as well. You can just ping one of us an email, whether it's mortgages or wealth, and we can sort that out for you.
Yeah, if you want to do something more generic and give a bit of background first before booking a time, you can also just Ravi, if you can pop it in, info@lighthousefinancial.co.nz, give us a bit of background and we can get it to the right person.
Cool.
Mark's one is a banger. Let me read this to you, Mike, because economist Mike is coming out here. Given unemployment is so low and we purchase a lot of goods from overseas where inflation is even higher and lots of people are on fixed mortgages, what is the likelihood, Mike, that what the Reserve Bank is doing by increasing interest rates will matter at all? Or could the pain follow through to 2024?
The pain could absolutely follow through to 2024. However, you've got a pretty large chunk of money rolling off, I believe, April next year. I can't remember the exact amount, but it's quite a steep cliff there. Yep, there is a lag effect on monetary policy, as like some people are fixed for 5 years. What an absolute stellar move. But most of the time, people have some shorter term fixes in there as well. Do we import inflation? Yes, we import a lot of inflation into the country. That will unfortunately only mean that interest rates get cranked up higher. Because if you are staring down the barrel of a really high inflation number or hyperinflation or a recession, you will pick a recession every day of the week, because it is far easier for an economy to recover from a recession than it is for an economy to recover from hyperinflation or a large amount of inflation. Yep, the pain's probably going to follow through to 2024. You're probably not going to see interest rates decreasing until the end of 2024. That was the latest prediction from the RBNZ.
2024? It's depressing. I've got a baby on the way, Mike. I got mouths to feed.
You do. Cool. Another one. How do we book half-hour session? Can my colleagues who couldn't dial in also speak to you? James?
Yeah, of course. More the merrier. This is like a engineering New Zealand thing. But also we just generally help everybody. So there's the links in the chat. Ravi, if Ravi's just popped them in, have a look, and then they'll be emailed out afterwards. If we jump on to the next one, I'm not a permanent resident in New Zealand and cannot buy a home. When I move my money over to New Zealand, should I keep it in cash or invest it in stocks, assuming 2 years?
Cool. Assuming that I want to buy a home as soon as I become a PR. Yeah. We're almost getting onto personalized advice here.
Nah, I can generalize this.
Yeah.
So generally speaking, if you have less than 3 years to invest, you should stay in cash. Yep. And the reason for that is I cannot guarantee the a better outcome than staying in cash. So stay in cash if you've got less than 3 years. Yep.
And then the other risk you're running there is just your exchange rate risk. I'm always going to advocate for having the money in New Zealand, having it in NZD, because then you are sure of exactly how much you've got and exactly how much you need to save.
Cool.
Anonymous attendee, how do I start a financial plan? James?
Well, of course, I'm going to say come and talk to us and we can do it for you. If you're going to kind of DIY something yourself, it is really like a financial plan is going, here is your current situation. This is where you want to aspire to be. So this is the kind of life I'm trying to build. And this is some metrics around it. So like SMART goals, what time frame, what dollar figures are around that, and then reverse engineering it. And what are the things I need to do to achieve that goal? And then you can underline the right kind of assets underneath it. So one of the big ones that gets slipped on is budgeting. Budgeting doesn't mean eating beans on toast, although I try and get Mike to do that. He just doesn't listen to me. It's about going, where is your money going? If I was to annualize how much you spend on clothes or dinners out or whatever, would you be like, yep, that's cool. It gives me a lot of value. I'm fine with that number. So then working out with the budget, how much is left over, then going, okay, KiwiSaver, manage funds if appropriate, investment property, buying your first home, paying down debts. If you've got credit card debts, all those kind of things, chop those up, pay them down. Very personalized, but that's kind of high level breakdown.
Yep. Cool. Last question we've got in the chat relating to KiwiSaver. This is normally used for first home buyers or retirement. However, Does it make sense to sign up for KiwiSaver if I plan to move countries in the next few years? James Blair, take it away.
Hell yeah, it does. And the reason for that, I mean, next few years, as long as it's a reasonable amount of time, a few different reasons. One is if you are moving overseas, you can take your KiwiSaver with you. So look into whatever that country is and see if there's any T's and C's that apply. But usually you can take the money with you or leave it back here if you're going to return one day. The other reason is government puts in $500 a year if you make the minimum contributions, and your employer will put a minimum of 3% towards it. Some do more. So you're missing out on things in the short term, and you can take the money with you.
Yeah, cool. Okay, that is all of the questions we've got in the chat. I hope that everyone's enjoyed the web. Oh, no. Oh, yep, sorry. That's what's fun from Kirsty. If you've missed any of the webinar, we'll add it to the Engineering New Zealand YouTube channel so you can watch it.
Cool. Thank you very much, everybody, for joining us. Let us fill out the survey. Let us know emails to come and look forward to talking to some of you one-on-one very soon.
Cheers.
Bye.